if oil prices surged 25% overnight, if shipping insurance premiums doubled before Asian markets opened, if central banks were forced into emergency meetings within 48 hours, the trigger would not necessarily be a recession, a banking collapse, or cyber attack. It could be a 21-mile stretch of water most people will never see in person. That stretch is the Strait of Hormuz. It is one of the most economically sensitive pieces of geography on Earth. And as Middle East tensions continue to simmer into 2026, this narrow corridor remains a live wire in the global financial system. But before we examine military strategy or diplomatic maneuvering, we need to understand something more fundamental. Why does this narrow strip of water carry such disproportionate economic weight? The answer begins not with politics, but with scale. Every single day, roughly 20 to 21 million barrels of crude oil pass through Hormuz. That represents close to 30% of global seaborne oil trade. In addition, approximately 1/5 of global liquefied natural gas flows transit this same channel. Translate that into economic reality. That volume powers factories in China, fuels aircraft in Europe, stabilizes electricity grids in India, and supplies petrochemical feedstock to industries worldwide. The exporters relying on this route include Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, and Qatar. The importers include China, India, Japan, South Korea, and much of Europe. Hormuz is not merely a shipping lane, it is a global pricing mechanism. And when a pricing mechanism becomes vulnerable, markets do what they always do. They look backward. Because this is not the first time geography has dictated global wealth. To understand Hormuz today, we must zoom out. Global power has always followed trade routes. The Suez Canal reshaped imperial dominance. The Panama Canal transformed Atlantic-Pacific commerce. Maritime choke points compress distance and concentrate leverage. After World War II, oil became the backbone of economic expansion. Industrial output, suburban growth, aviation, mechanized agriculture, all scaled on hydrocarbons. Then came 1973. The oil embargo by Arab members of OPEC triggered one of the most severe stagflationary shocks in modern economic history. Oil prices quadrupled, inflation surged. Western economies slowed dramatically. The lesson was clear. Energy flows are macroeconomic triggers. But history did not stop there. Because the Persian Gulf itself would soon become a battlefield. During the Iran-Iraq War in the 1980s, commercial tankers were directly targeted in what became known as the Tanker War. Insurance premiums exploded. Freight rates surged. The U.S. Navy intervened to escort vessels. Actual supply losses were limited, but prices moved anyway. Markets learned something critical. Credible threat is enough. You do not need a full closure. You need probability. And that probability has returned in cycles, again and again, which brings us to today. The outbreak of the Israel-Hamas war in late 2023 did not directly shut Hormuz, but it shifted the risk calculus across the region. Iran-backed groups signaled alignment. Proxy networks became more active. Regional alliances hardened. The probability of horizontal escalation increased. Simultaneously, Houthi forces in Yemen intensified attacks on commercial vessels in and around the Red Sea. While geographically separate from Hormuz, the message was unmistakable. Maritime choke points are vulnerable to asymmetric warfare. Insurance premiums rose. Shipping firms rerouted. Freight indices climbed. Meanwhile, U.S.-Iran tensions remain structurally unresolved. Sanctions persist. Naval patrols continue. Occasional tanker detentions remind markets that escalation risk is never zero. So the question becomes, if risk materializes, how does it transmit? Because this is not simply a geopolitical story, it is a macroeconomic transmission system. If Hormuz were disrupted, even temporarily, the impact would cascade. First, oil prices would spike immediately. Futures markets would price in supply constraints within hours. Second, inflation expectations would rise. Energy feeds transportation, logistics, agriculture, aviation, and manufacturing. Headline CPI would reflect higher fuel costs quickly. Third, central banks would face renewed dilemmas. Tighten to fight inflation, or ease to cushion growth? Fourth, currency markets would adjust. Energy importing nations could see widening trade deficits and weaker currencies. Exporters might benefit short-term, though prolonged instability could deter investment. Fifth, equity markets would reprice sectorally. Energy producers might rally. Airlines and logistics firms could see margin compression. Hormuz is not an oil variable, it is a cross-asset volatility amplifier. But markets are adaptive systems, and over time, they attempt to reduce vulnerability. The past decade has seen diversification. U.S. shale production expanded significantly. Renewable energy capacity surged in China and Europe. Strategic petroleum reserves were deployed during crises. These shifts reduce exposure at the margin. But oil remains globally priced. Even nations that import little directly from the Gulf feel price spikes through integrated markets. The energy transition is real, but it is not yet dominant enough to neutralize chokepoint risk, which means Hormuz still represents leverage. And leverage, in geopolitics, shapes power. Iran's position along the northern coastline of Hormuz grants it influence disproportionate to its GDP size. Gulf exporters depend on open sea lanes for fiscal stability. External powers maintain naval presence to secure passage. Military budgets, sanction strategies, diplomatic negotiations all orbit around, ensuring that this corridor remains open. When geography concentrates leverage, markets concentrate attention, which leads to the deeper insight for investors. Financial markets often appear abstract, driven by liquidity, algorithms, and sentiment. But beneath the abstraction lies physical infrastructure. Ports, pipelines, shipping lanes, and sometimes a 21-mile corridor that anchors global pricing power. Professionals who understand choke points understand tail risk. They recognize that when oil volatility spikes, it may not be about supply and demand curves alone. It may be about naval deployments and missile ranges. Hormuz has remained open through decades of conflict. That resilience creates complacency. But resilience is not immunity. The global economy is vast and technologically advanced, yet it remains anchored to hydrocarbons that pass through narrow, politically sensitive geography. Until the energy transition materially reduces oil's dominance, the Strait of Hormuz will remain one of the most important variables in global finance. Its waters may look calm. Its leverage is not. If you found this breakdown valuable, subscribe to Behind Economics for more data-driven deep dives into the forces shaping global wealth and power. Share this video with colleagues tracking energy, inflation, or geopolitical risk. And now we want to hear from you. How do you see current Middle East tensions reshaping energy markets and global capital flows over the next 5 years? Leave your analysis in the comments below. Let's go beyond headlines. Let's go behind economics.